Hello and welcome to this podcast brought to you by Momentum Global Investment Management. Now, much of Britain's retail investment sector focuses purely on beating benchmark returns rather than delivering on client objectives. But in doing so, are managers creating a potential chasm between client needs and investment outcomes? To discuss this, I'm joined by Andy Davies, Head of UK Retail, and James Klempster, who's Head of Portfolio Management at Momentum. Gentlemen, welcome to you both. James, I'd like to start with you first. Let's take us back to basics. Benchmarks. Firstly, what are they? Why are they important? And how are they affecting fund performance?
Benchmarks are really actually a very simple concept, and it's a classic example of things that we do in this profession, which we're sort of over-engineered, over-egged really. And all a benchmark is a means by which we can measure success or lack thereof. So if you bring it back into the real world, in athletics, for example, it's the time to beat. So Usain Bolt is the benchmark in 100 meters and 200 meters. And, in investment land, again, the idea is just having something that you can judge whether you're doing a good job or not. Traditionally, it's been investable market indices. So in the UK, maybe the FTSE or the gilt index are benchmarks for that particular different type of investments, either equities or bonds, and so that they've become sort of ubiquitous as a way of judging whether portfolio managers have done a good job relative to those benchmarks. But as you've already alluded to, the fact that they don't actually speak to whether they've done a good job for what clients need in the long run from their investments.
And Andy, are we then too constricted by these benchmarks?
I think often we are. I think particularly in the fund solutions world, where managers blend either other funds or blend different markets together to create a solution, then I think they can be really quite restrictive. You'll often find managers will have more than one eye on the benchmark and fearing straying too far from it, or particularly from their competition, that they'll blend things in a very vanilla way. Like I say, far too frightened about the consequences of going too far away from that benchmark. And what you get as a market is a very big cluster around that benchmark. Very few people either significantly outperforming or underperforming because of the importance that they put on that benchmark.
So it sounds then like benchmarks can be as much a straitjacket as a means of measurement. Are they increasingly irrelevant for investors who are interested in outcome-based investments?
I think they are. I think if you think about benchmarks, or if you think about investments with a client, using a client's eye, and you think about what clients increasingly ask for, they ask for reasonable rates of return without taking too much risk. Rarely will a client ever say, I want something that looks like the FTSE index or the gold index or anything of that sort of nature.
So how have we found ourselves in this position? Why are we slavishly following the FTSE or whatever index that we choose?
I think it's habit as much as anything else. I mean, benchmarks are very important to institutional investors. It's key for them to understand whether their particular niche holding in, again, the UK equity market is doing a good job or a bad job. And that helps them to blend portfolios together to create a solution. But for the problem is that's been sort of transposed onto the needs of the end user. And, the end user doesn't care about that. The end user doesn't care about a tracking error or, active share, really. Nobody gazes into the eyes of their newborn child and thinks, if I put away 50 quid a month, maybe one day I'll be able to put them to a good education if I get a low tracking error. People think if I can get a certain amount a month return, I can get that over a number of years, then I can pay for these things. So the point is it gets transferred onto the end user and it's inappropriate for them.
And I think that fund managers, and particularly marketing departments at asset managers, use benchmarks almost as a comfort blanket. It's the way of showing how well we've done. But you get some ridiculous statements used by fund management groups who are constrained by benchmarks. These are the sorts of people that will turn up at a client and tell them that they've done a brilliant job for them by only losing 8% over the last 12 months. Why? Well, because the benchmark was down by 10 or 11%. Now, I've never met a client, I've never met a person who would be comfortable that that's a good result. Particularly where clients, if you follow my previous thought, give me a reasonable rate of return without taking too much risk, that generally means a positive return. So clients are looking for somebody who's on their journey with them, really. If the client needs a specific return, they want a manager whose strategy is aligned to that return rather than somebody who's slavishly following a benchmark.
But coming back to your relevance point, I think the other thing is, I think we've seen a change in the reasons why people invest over the last decade, and we're going to see it perpetuate into the future. The point is, in the old days, defined benefit pension land, your investments for most people didn't really matter that much. It was a bit of a flutter on the side, or hopefully something you'd make a lot of money, or you'd be worried about protecting capital. So if you got the benchmark's return or around there, you'd probably think that's quite good. But now, because you're on the hook for your own pension, your savings are your problem, not anybody else's. What the benchmark does isn't irrelevant. It could be good for you in retirement. It could be terrible for you in retirement if the timing's wrong. And so again, much more relevant for most people who are saving for their retirement, crucially these days. The outcome is very, very important.
Now, this is interesting because, of course, as you have alluded to, the pensions environment has radically changed from defined benefit, the old gold-plated final salary schemes, to defined contribution, where we're each more responsible for our pension outcomes and other saving products as well. There are a plethora of different ISA products out there now. So what you're saying is that the old way of thinking in terms of the outcome no longer works, is no longer as relevant.
That's my view. And I think we're still very early in this mental transition, which goes from the fact that my pension is someone else's problem to my pension is my problem. I think we're actually sleepwalking towards a crisis in the sense that very few people are sufficiently saved for their retirement. And I think in the next 10 to 15 years, you could easily start having conversations with people where they stop talking about willingness or ability, which is the traditional kind of measures of understanding of risk, much more to necessity, because you're going to get people who are getting close to retirement who are chronically undersaved. And they're going to need to then think about, what do I need to get me back to where I need to go? And again, that speaks about outcomes. It's not about tracking error. It's not about a little bit of Sharpe ratio here or there. It's about getting the right outcome for your investments.
James, you make a really interesting point in there. So you talk about risk. And of course, risk can be a benchmark as well. It doesn't have to be an index that's the benchmark or a market that's the benchmark. Risk can often be a benchmark as well. And we believe that whilst risk is really important, particularly in the IFA world, where it is a fundamental part of any IFA's investment process, it's only a part. And that it's actually an irrelevant benchmark again. Because if you manage a portfolio with risk as the starting point, then by definition, the return is an accident of that process. Again, if you come back to that conversation that we had previously, where you're trying to explain to a client that losing 8% is a result, again, try and explain to somebody, we didn't get you enough money in retirement, but we didn't. But the good news is we didn't take too much risk along the way. I know what a client would say to me. Well, actually, it's far more important that I've got what I need to retire on than you didn't take too much risk on that journey for me.
Okay, so we have a sense then of the problem that investors and perhaps managers are facing here. So put your money where your mouth is. Where does Momentum stand with this? What approach are you taking that's different from other managers out there?
Well, we're an outcomes-based investment manager. That's where we start and finish. And we know if we've done a good job, if we get the right outcomes for our clients. So, when we get to work in the morning, we look at our portfolios and what we think is what combination of assets together give us the best probability of achieving the outcome we've suggested to clients we will achieve, whilst taking as little risk as possible. So it takes all the different factors, what we've been talking about already, in terms of focusing on outcome, also focusing on risk, but not letting risk dictate the investment process. They have to come in combination. And then what we do is we try to deliver the best risk-adjusted return for clients in that environment. So the key is focus on the outcome first, build your whole process around that, identify asset classes that are attractive and combinations of asset classes that are going to be best for your clients, rather than what can we run? Well, let's try and sell that. Or how much risk are we willing to take? Well, let's try and sell that. It's much more holistic than that, really.
Andy?
And more specifically, in our range of solutions in the UK are targeted. So they target inflation plus returns over a typical investment cycle. And I suppose the way I would describe that, as you can probably gather from my accent, I'm a northerner, so I travel into London. When I turned up at Crewe Station at some ungodly hour this morning, there were any number of trains that I could have got on. There were expensive trains, there were cheap trains, there were fast ones, there were slow ones. Some of them had brilliant records of punctuality and customer service. So I had a huge choice, a little bit like the investment arena, a huge choice of options available to me. What I did when I selected which one to get on was I almost walked to the front to see where it was going. There was no point in me getting on any of those trains, however great they might have been, if they weren't going where I wanted to go to. So if you think about that from an investment point of view, if I'm a client who needs to invest money over a 20-year period and my advisor working with me tells me I need a 5% return compound, I need to know that the fund manager that I trust my money to is aligned to my goal. I need to, just as I needed to know when I got on the train this morning that the driver had London as its destination, because otherwise I'm trusting in blind faith or just crossing my fingers that I'm going to end up where I need to be.
So it's a simple understanding of where your destination is going to be, and that destination being the savings outcome that you want.
Yeah, absolutely. I mean, if you think about how financial services has evolved over time, and particularly how technology has come to be involved more in the way that advice is given, there are so many tools available to advisors now to help clients plot that financial journey, whether it's a cash flow modelling tool, whether it's some sort of system which links all of their financial products together so that you can see exactly how much you've got and whether you're on track. Ultimately, there's a journey, an established journey in place. I think gone are the times where a financial advisor was just trying to produce the maximum possible return. And even if he was, there was no guarantee that maximum possible return was going to be enough. And so now, particularly in a lower growth environment that we find ourselves in, it's vitally important that you know what that journey looks like and that you align, or you have a manager who's aligned to the targets that you need to tick off as you follow that journey through to your retirement or whatever your goal is.
James, I'm sure you agree with that.
Yeah, we're only very much in the early days of how technology is going to impact investing, particularly from an individual client perspective. I think we will see in time a real bifurcation of clients' desires. Some will want to interact with a human and take it forward that way. Others would much rather be trading through a variety of different platforms or with a mechanized advice process. And I think, we're very much in the early days of that, and how then advisors can plug into that to take it forwards is still very much in its infancy.
So you're referring to robo-advice there. But do you think ultimately the key arbiter in this is the advisor? They're the people that are going to be suggesting to investors to start thinking about outcomes rather than simply process.
I absolutely do. Yeah, I do. Just to pick that technology piece up and link that to my train journey, if I think about how
the train didn't break down, did it?
It didn't. No, it didn't. But if I think about how I bought my ticket, one of the way I could do that would be using an app. So something like the Trainline app. Now that tells me that that what that does is the job, I guess, of an advisor in this case. It analyses all the possible options and then picks the best one for me. Where I think technology's moved on, and particularly in the world that we're talking about outcomes-based investing, is while I was on that journey, I can press a little gadget on my Trainline app that's a live tracker, which tells me actually whether when I arrived at Nuneaton at whatever time it was, whether I was on time or not. Now, if I had a desperately important meeting and there were the other options, there was a way that I could have got off a late train and jumped on something that was going to get me in time. That is technology in practice. And again, for me, the parallel in outcomes-based investing is a tool that perhaps helps me along that journey, make sure that at every point my investment is doing everything it needs to do to ensure that I get there on time with the right amount of money.
Now, of course, all of this raises questions over the future of passive trading, which follows the benchmark. James, what do you make of that?
Passive investing does follow a benchmark, and I don't think that's going anywhere anytime soon. I think it's a useful tool for investors, whether they're institutional or potentially even individual investors, to get a particular exposure to a particular market very cheaply. So I don't think it's going anywhere anytime soon. What you are seeing is an evolution in the benchmarks against which they're managed, this so-called smart beta. And over time, I think we'll see a growth in the smart beta at the expense of traditional passive investing. And they've got a number of characteristics that suit certain investors better. But it's still a long, long way from actually focusing on what clients need over the long term. So while it's an improvement on certain characteristics of traditional passive investing, smart beta is by no means, I don't think, the end game. And I think we will see further evolution there to get us closer to outcomes-based investing over time.
I think the other thing to bear in mind is that managers like James will occasionally use passive strategies, either where cost is important or where he can't see value in buying a specific fund. But bear in mind that in an outcome-based solution, these are only building blocks. As James said, if you buy a passive solution, you're still a slave to the market. You still will only ever achieve the returns that the market produces, watered down, of course, by the impact of fees. But they still do not. They're still not targeting specific outcomes, and therefore can only ever be used as building blocks to reduce cost.
Final question to you both. It's crystal ball time now. We've covered a lot of ground here, but what do you think the future of investing is going to look like in the light of how we've been thinking about benchmarks here? James, first, what do you think the future is going to be?
Look, benchmarks aren't going anywhere anytime soon, largely because a lot of people, particularly institutions, still rely on them as a reference point to judge performance. And I think that's fair. But what I think we need to move away from is forcing benchmarks down the neck of normal people who are trying to invest for a particular reason, for an outcome. And so, I think over the next decade or two, the prevalence of benchmarks in normal conversations will drop a lot. I don't think people will be talking so much about what's happened in the stock market on a daily basis. And my dream, I suppose, is that it doesn't get flagged up on the news. I mean, it's a bit of an aside, but the UK benchmark only comes on the news when it's a bad news day rather than a good news day, and that encourages all sorts of bad behaviour, short-termists from an investment perspective. And if you can take a step back and say, it doesn't matter. I'm on a very early stage to a journey to achieve a certain outcome on a very long-term basis. I don't need to fixate on the performance of this or that measure over the very short term. So hopefully, and maybe this is wishful thinking, given, if anything, we're seeing an increase in short-termism, but hopefully this sort of investing, long-term, outcomes-driven investing, reduces people's desire to fixate on the here and now, on the very short term, look through the noise, look out much longer term in nature, and actually sort of invest for the right reasons, which is to buy assets at a discount to their fair value, hold it for as long as you can, and realise the profit from that position.
And Andy?
I think at the risk of using Brexit as a topical point, I think, again, if I put my client hat on and think about what I would be feeling given all of the noise and arguably hysteria that happened in the market in the early days past the vote, I would want to know that if I had trusted somebody to look after my money for me, that if Brexit means general lower growth going forward, I would want to know that my fund manager was doing something about that. Now, if I think about a relative fund, a benchmark-driven fund, the reality is fund managers of those funds who, as I say, concentrate themselves around that benchmark, broadly will carry on doing what they've always done. The person who suffers is the client because they become a slave to the market. If you think about an outcome-based solution, don't call them funds, an outcome-based solution, particularly a solution which targets a particular rate of growth, if underlying market conditions suggest lower growth, then that fund manager is going to have to do something different. They're going to have to moderate the way that they do things. They're going to have to change how they manage that money to give themselves a fighting chance. And of course, there's no guarantees that just as a relative fund is a cork bobbing around in the ocean, so is a non-benchmark fund, an outcome-based fund. But at least as a client, I know that the manager is doing something different to help me to get to my target. So I think, if you look at developments in the market of late, the number of traditional asset managers who've launched outcomes-based solutions tells me that this journey that we've been on for a long, long time is one which others will follow, I'm sure.
Okay, so watch this space then. Gentlemen, thank you both very much. Andy Davies, Head of UK Retail, and James Klempster, Head of Portfolio Management at Momentum. And you can find out more about the ranges of services offered by Momentum Global Investment Management by going to www.momentumgim.co.uk.
This podcast is only intended for use by the original recipient, either a Momentum GIM client or prospective client, and does not constitute an offer or solicitation to any person in any jurisdiction in which it is not authorised or permitted, or to anyone who would be an unlawful recipient. The original recipient is solely responsible for any actions in further distributing this video, and in doing so should be satisfied that there is no breach of local legislation or regulation. This podcast should not be reproduced or distributed except via original recipients acting as professional intermediaries. This podcast is not for distribution in the United States. Prospective investors should take appropriate advice regarding applicable legal, taxation, and exchange control regulations in countries of their citizenship, residence, or domicile, which may be relevant to the acquisition, holding, transfer, redemption, or disposal of any investments herein solicited. Momentum Global Investment Management Limited, company registration number 3733094, has its registered office at the Rex Building, 62 Queen Street, London, EC4R 1EB. Momentum Global Investment Management Limited is authorised and regulated by the Financial Conduct Authority in the United Kingdom and is an authorised financial services provider pursuant to the Financial Advisory and Intermediary Services Act 37 of 2002 in South Africa.